Yo, welcome once again to this tutorial. Today we are going to treat capital allowance, Finance Act 2019-2020. The, the, the law from 2019 still flows to 2020. That was why I put 2019/2020. Today we are going to look at capital allowance. Yes, we are going to solve this question. Sorry, I use my beak to write it. I got this question from the ICAM Pack taxation. You can check it off skills level page 305, illustration 20.1. We're going to solve it together here. But before we do that, I would like to refresh our mind a little on capital allowance. That is what I normally do. A little is going to be fast so that we'll come back to this calculation. So let's dive into this capital allowance. Capital allowance are a form of relief granted to any company which incurred qualifying capital expenditure for the purpose of what? Trade or business during a basis period in respect of property, plant and equipment, that is PPE, that are in use at the end of the basis period. It is self-explanatory. They are those words: relief granted to company as long as they are within the basis period, as long as they are in use within that basis period. So simple. Now, what is the essence of this capital allowance? Now, the essence of capital allowance is just to replace depreciation. That is the essence. Just to what? Replace depreciation. Now, if you are computing for your tax, once you get your net profit, you add back what? Your depreciation. Now, this capital allowance is relieving some amounts. They are giving you some allowance in place of depreciation. I don't know if you get it. Yeah, that amount that was added back, that depreciation, they now use capital allowance to release some. So the essence is just for the purpose of depreciation, to ease off the amount that was added back on depreciation. Now, let's go further. Let's look at the type. Initial allowance, AI, artificial intelligence, is taking over, but this is not artificial intelligence, please. If you are not using artificial intelligence now, please start using it. It's very good. It helps a lot in our daily activities. But that is not where I'm going. This is initial allowance. Now, initial allowance, this is a relief that is granted in the year of assessment, in the basis period of which a qualified capital expenditure was incurred, and it is claimable once in the life of an asset. The keynote there is that it is what's claimable once in the life of an asset. Once you purchase this asset, initial allowance is entitled to it just once in the life of that asset. So it's a relief that is granted in the year of what? Accessible, in the basis period of which qualifying capital expenditure was incurred, and is granted just once. I believe we are getting it. Now, annual allowance. This is granted every year on the residual of qualifying capital expenditure incurred on non-current assets after deducting initial allowance. After deducting initial allowance, I'm going to show you something here now. Now, this annual allowance is what? This is granted every year on the residual of qualifying capital expenditure incurred on non-current as after deducting the initial capital allowance. Now, if initial capital allowance is calculated as 5. What you do here, you get the cost of the asset minus 5. That is what they are saying here. You minus the initial allowance from the cost. That's what they are saying. Deducting initial, and after deducting initial allowance from the cost. That is what annual allowance is all about, and it is deducted every year in the life of the assets. We will do the calculation, then we'll come there. Now, investment allowance is no longer obtainable. The current Finance Act 2022 Finance Act is no longer obtainable. Please, they've scrubbed it out. Yes, there is no longer initial allowance. So that is that about this. So there is another keyword there that I found out that confuse people a lot. Balance sheet. Mind you, there are other types like royal development and all that. I'm just hitting at the key ones in which you meet. Now, balancing charge and balancing allowance. These two things confuse people a lot, and that was why I decided to come up with it. Now, in a nutshell, balancing charge is what? When you dispose an asset and the proceed is more than the tax rating that value, it becomes what? Balancing charge. Are you getting me? When you dispose an asset for 200 and the tax rating that value is 100, is balancing charge. The additional amount here, the tax authority will charge it. They are not smiling. They don't want to use that to see an income. So they are going to charge it. It's become balancing charge. And this amount will be added to your tax liability in which they are going to charge. It's an additional to pay. Yes. Increase in tax liability. That is it. Balancing charge. When you make your sales and the disposal of the asset is more than your tax rating that value, it is called balancing charge. When the disposal of sales is less than tax rating that value, is called balancing allowance. When they discover that you made the sales, you dispose your assets, and you didn't make any profit from it, they will do what? They will allow you. They will say, okay, let him be. Balancing allowance. Let him go. Balancing charge. In case if you forget, just put yourself as the tax authority. You say balancing allowance, you forgive him. Balancing charge, he must pay. We are not forgiving him, he must pay. You understand? So balancing allowance reduces your tax liability and is in negative. That's why I put negative here. Reduces your tax liability. I believe you got that. So let's go to the condition for capital allowance. Condition for granting capital allowance. 1, just these are the key things. Just know this. 1, the company must have incurred qualifying capital expenditure, PPE. Qualifying capital expenditure. That is 1. They must have incurred this. 2, the claimant must remain the beneficiary owner of the asset at the end of the basis period of the company. That is to say, he bought this big. He must remain the owner of this big at the end of the accounting period. He must not dispose it. Once he disposes it, he's not entitled. He must remain the owner. Thirdly, the asset must be in use wholly. Must be in use what? Wholly. Exclusively, necessarily, and reasonably for the purpose of the business, as at the end of the basis period. The asset must be used wholly. It's not, you will not go and buy a car, and because you think you are the owner of the business, you are using the car for your just for your personal use. It must be for the purpose of the business. So if it is not for the purpose of the business, you are not qualified. You're not qualified to claim any capital allowance on it. So just know this principle. These are the, in fact, in any exam, these are, if they must ask on capital allowance, these are the things they will ask you theoretically in which you will handle. Now, let us solve this question. I believe you're seeing it. I'm going to read it. Sorry for using big. I'm very sorry. I apologize for that. Now, I say you can get this from the ICANN pack. That is taxation skills level, page 305, illustration 220.1. Now, a company commenced business on February 1st, 2020, and made up its accounts to March 31st every year. It acquired property, plant, and equipment as follows. You're getting it. Date of acquisition is this. 1st February 2020, building 5 million, furniture, right? This, machinery, this, Jeep, this amount. Now, the turnover for each of the relevant assessment year was over 27 million naira. Now, this figure here is just to remind you that this company must be assessed to tax for each of the relevant. It just tell you that this company made enough money in which they can be assessed to tax. Now, before I jump, let me just show you something. When businesses are classified into small, medium, and big, once you make from 0 to 25 million naira, you are not paying any CIT, company income tax. It's nil. You understand? It's nil. But when you make 25 to 100 million, you are paying 20%. If your turnover is 25 to 100 million, you are paying 20% after computation of your tax liability. 0 to 25, you are not paying anything. 100 million and above, you are paying your CIT is 30%. So this company here fall within this medium company here. That is to say, they are subject to what? To tax. So they just put it here to let you know that this company is subject to tax, but we're not using it for anything in this question. Now, they say required, determine the basis period and compute the capital allowance for all relevant year of assessment. Take note, relevant year of assessment is very, very key. Relevant year of assessment, taking into consideration the relevant provision of what? The Finance Act 2019. So this question, we are going to solve it here, now, and direct. So let us start. But before we start, let's refresh our mind on what I did a video on commencement rule, because the same principle we are going to take that we took there in that video is the same thing we are going to take here also. Now, for a business that is commencing, that I'm not going to go back deep into that. For a business that is commencing, let's check the basis period of this business here. Basis period, because the question say determine the basis period and compute capital allowance. We are asked to determine the basis period first. So let's determine the basis period. Now here. A company commenced business on what? 1st of February. 1st to what year? 2020. And made up its accounts to what? Made up its account to March 31st every year. February, March 31st, March 3, 2020. 20. So here now, because it is preceding year basis that we are using, and the new Finance Act said that from the month of commencement to the end of the day, then starting from the very first day after the end of the business to the end of the following year. Watch that video, you get more explanation on this. Let me not waste much time here. Now, here, this account will be assessed when? 2021, year of assessment. Now, in 2022 now, we'll assess, it will start from 1st April 2020 to 31st March, 2021. You can still go further. Say the next year we'll assess 2023 will be like this: 1st April 2021 to 31st 3 2022. So these are the basis period. Basis period for commencement is the same thing as the basis period for capital allowance. So the capital allowance basis period will now read basis period for capital allowance will read this. Still the same thing. Hope you're seeing this. 31st 3 2020. First for 2020 to 31st 3 21. Yes, you are seeing it. So this is the basis period. So we've solved the number one question, basis period. Now it is left for us now to classify these things, because these are the rough work you do before you start solving. Now this business, they started it when? They started the business February, and this is the year of acquisition. They acquire all these assets. These are the dates they acquired the assets. Now, building was acquired when? 1st February 2022. So it fall under where? It fall under here. Right? 1st February to furniture was acquired here. It still fall under the same 2021 year of assessment. The third one is what? You're seeing it, yes. Sorry for using big. 1st of April 2021 and 3rd March, 3rd of May, this May 2022. These two fall under here. This one is not among the relevant year. These are the two main relevant year of assessment. This one, I just added this one. This one is not among the relevant year of assessment. The relevant year of assessment is 2021 and 2022. Is that okay? Now that we've actualized this, so that is to say here now, we'll say year of assessment 2021, we'll have what? Building, we have furniture. Then year of assessments 2022, we have machinery and motor vehicle. So this ones was acquired in 2021 year of assessment. 2020. This one was acquired in 2021 according to 2021, 2020, which will be assessed in 2021, which will be assessed in 2022. Now, once you have gathered this information, you are set to solve. I'm breaking it down for you. Now, let's come here. Now, we have our building here. The initial allowance is 15, annual allowance is 20, furniture, initial allowance is 25, annual allowance is this. This rate will be given to you in the example, so don't panic about it. Don't panic about it. Okay. So now, year of assessment 2021. The cost of the assets. What is the cost of the assets for 2021? We have 5 million for building, 1.5 million for furniture. So you are going to short it to 5,000 and this thing. Now you see, what you do now is this. You see, I hope you are seeing this. First, you take this basis, first to 2020 for building, give you 5,000. Then the same year, furniture 1.5. So this place now we're going to do some calculation here. Now, initial allowance, I told you it is claimable once in the life of an asset, while annual allowance is every month. But from here now, from here, this asset was bought here February. These two assets was bought February. Okay, and they use it to match. That is to say, the assets spent 2 years. They only use it for 2 years in the year of assessment, 2021 year of assessment. So here now, let's get our initial allowance first. Initial allowance will now be 15. Let me get my paper, sorry. Oh, very sorry for that, very sorry for that, very sorry for that, bridges. Now, here is it. Initial allowance is equals to 5,000 times. The rate is what? 15. Divide by 100 will give you what? 5,000 times 15 divided by 100 will give you 750. So this is your initial allowance. Will come here. Here allowance, initial allowance 750 in jackets. Then let's do the same for furniture. You're seeing this 1.5 times 25 divided by 100 will give you what? Always use your calculator. My lecturer in school then will always tell you, whatever you're doing, make sure you use your what? Your calculator, so that you'll be sure of the figure you are getting. 375 in jackets. Are you there? Now let's go to annual allowance. Let's go to annual allowance. Now, for you to get annual allowance, will now be equals to cost minus initial allowance, like what I said earlier, times the rate. The rate here is 20%, divided by 100. Will now give you what? Your annual allowance. So that is to say 5,000 minus 750 times 20 divided by 100. This will now give you 5,000 minus 750 will give you 4250 times 20 divided by 100. This will now give you times 20 divided by 100, 4250 times 20 divided by 100. 20 divided by 100. Yes. Well, so I just noticed that this annual allowance here is 10%. Check the question. It's 10%, and I mistakenly put 20% there. So here is going to be 10%. Sorry. Here is going to be 10%. So here is going to be 10%. So 4250 times 10 divided by 100 will give you 425. Now, this 425 is for 12 months. And what we are looking for here is just how many months? We are looking for just 2 months. Just 2 months, because they started business here and they made up the account here. Just February and March. So we are looking for the figure of 2 months. This is the figure of 1 year. So what you do now, you prorate. That is where proration enters. Now, these are the type of question they will set for you. You have to prorate. So you have to know this proration of a thing. If the year is complete, like it's 12 months, you just put this amount here, this annual allowance here. You put this 425 here, and you walk away with it. Start going. But this one, they need 2 months there. So what do is this. You see, 425 times 2 divided by 12. For you to get 2 months, we want to get 2 months from here. 425 times 2 divided by 12 will give you 70.8. Let's approximate to 71. Is that okay? I hope you understand this. So we'll come here and put our annual allowance for 2021 is 71. You jacket it. Then you do the same thing here too. It's like I'm going to need many of these. So I just want to be explicit in what I'm doing here so that you understand it better. Now for furniture. We use the same formula we use here, or let me just can squeeze something in here. Now what we are looking for annual allowance for furniture is equals to cost minus initial allowance times what? What are we times here? It's 20. Divide by 100. Now, the cost is how much? The cost is 15. You are seeing it. 15 minus this is the initial allowance. 375. 375 times 20 divided by what? 100. This will give you, let's do it together. 15 minus 375 times 20 divided by 100 is giving you 225. 225. This is for 12 months. Remember, we are prorating. Now, for us to get 2 months that we need, because they fall into the same year of assessment, 2021, so we need 2 months from there. We say 225 times 2 divided by what? By 12. Divided by 12, this will give you times 2 divided by 12. This will give you, you're seeing it, 37.8. Let's approximate 38. Is that okay? So we'll come here and put 38. We'll jacket it. Put it like this. Now remember, here there's nothing here because no asset was acquired here. No asset was acquired here. You're getting it. So let's sum up here. You now say 5,000 minus this, 15 minus this. Then you total it like this. Let's do 5,000 minus 750 minus 71. Will give you 4. Will give you, yes, will give you 4179 as your tax written down value for building. Let's check for furniture. 15 minus 375 minus 338 will give you 1087. Let's add it like this. 750 plus 375. Here will give you 1125. 71 plus 38 will give you 109. Then add it up plus 1125. 1, 2, 3, 4. So we are done with 2021. So let's check our question. Now for 2022 is the next relevant year of assessment that we are going to. 2022, in which we have machinery and motor vehicle. Machinery and motor vehicle. So let's go with the cost. Is that year 2022? The cost. So let me get the cost here. The cost for machinery is 2 million. So 2 million. But let's put the date of acquisition 1/4 2020 and 3/5/2021. There is nothing here. They will now have hope you're seeing this initial allowance, then annual allowance. Then the cost here is 0, machinery is 2,000, GPs, motor vehicle is 3,000. Now, here now, what we're looking for here is our initial allowance will not be claimable here again. It's just annual allowance. So let's put our annual allowance. Remember, we solved for annual allowance for 12 months, which is this for building. This for building. Right, this is for furniture. I believe you remember how we solved this. So this is the amount you just put, sorry, not this one, but this, not this, please. This is the prorated amount. This is the annual allowance in which we prorated to get this. So motor vehicle 425, no initial allowance 425, put it in jacket here, the allowance 225. Now let's handle this very well. Now for machinery, we are going to apply the same method we use, but I'm still going to do the calculation so that we can refresh memory. For machinery, we need initial allowance. Initial allowance is what? The cost is how much? 2,000 times the rate is 50. You need to see the rate. The rate is 50 times 50 divided by 100. This will give you 2,000 times 50 divided by 100. Going to give you 1,000. So you come here and put initial allowance 1,000. You jacket it. Now for us to get our annual allowance, you say annual allowance is equal to cost minus initial times rates of annual allowance is what? 25%. 25 divided by 100. I'm just making this so that you know how we got all this. Now the cost is 2,000 minus our initial allowance is 1,000 times 25 over 100 equals to 1,000 times 25 divided by 100 equals to what? 1,000 times 25 divided by 100 to give you what? 250. Now this 250, we are going to write it here. Do you know why? We are not going to prorate here. Reason be it is that in this computation that we did here, the year of acquisition is first what? April. You see it from the question. 1st of April is the year of acquisition. Now, from the year of acquisition to the end of the accounting year, which is 31st March, it was used all over the 12 months. So that is why we are using 12 months. We are not prorating here. So the amount there, we're going to put 250 for our annual allowance. I hope you understand. Here, there is no proration. We are not prorating because why? The whole asset was used within 1 year. It was bought on 1st of April and they use it over to the end of the accounting year. Now, the second one, that is motor vehicle. Motor vehicle was purchased on 3rd May, January, February, March, April, May, 3rd May 2022. It was purchased in 3rd May. Now, let's solve for the initial first. Motor. Initial is equals to the cost 3,000. Our initial here is 25%. Here is it. 25% all over 100. Sorry, I'm taking this thing one by one so that you will know it. 3,000 times 25 divided by 100 will give you 750. Is it 750? Our initial allowance, let me see. 3,000 times 25 divided by 100. 750. Is it 750? Let's check something. Sorry, our motor vehicle, the initial allowance is 50%, not 25. It's 50%, please, not 25. So here is 50. So be conscious of these things. Please, at times it can be confusing because of exam tension and all those. Please be conscious of where you are picking and make sure you're picking the right one. 50. 3,000 times 50 divided by 100 give you 1.5. Yes, because I know this. To give you 1.5, your initial allowance is 1.5. You jacket it. Now let us get our annual allowance. Let's check the computation. This thing was bought on May, that is April. They did not use it in the month of April. They started using it in the month, they bought it in the month of May 3rd. May 3rd. May, you can't May included. June, July, August, September, October, November, December, January, February, March. That is 11 months. They've used it for 11 months. They did not use it on the 1st of April. It was used for 11 months, remaining 1 month. So in this case, we are going to do what? Prorate. Now, you see, annual allowance is equals to cost minus initial allowance times what is our rate? 25 all over 100. This is now equals to 1.5 minus, sorry, our cost is how much? 3,000 minus initial allowance is 1.5 times 25 all over 100. This will now give you 1.5 times 25 all over 100. This will now give you what? 1.5 times 25 divided by 100 and give you 75. To give you what? 70. To give you 75. Let's add again. 1.5 times 25 divided by 100 375. Please, to give you 375. Now, normally, this ought to be your annual allowance. But because this asset was not used completely for 1 year, it was used for 11 months. So in this case, we're going to prorate. What do? You say 375 times 11 months. We are looking for the amount of 11 months out of 12 months. Are you getting me? This asset was used for 11 months. If you check it, maybe some of you might be confused. Here, it was used for 11, it was bought on May. They use it for that May, use it May, June, July, August, September, October, November, December, January, February, March, April, the next year. They did not use it that very April it was purchased. So we are left with 1 month. We are looking for 11 months. So just get familiar with this prorating times 11 divided by 12. 375 times 11 divided by 12 to give you 343.75, approximately 344. So our annual allowance here is 344. Hope you are getting it. So let's get our tax written down value. So here you said this minus this, this minus this, this minus this, this minus this, this minus this. So let's 4179 minus 425, 3754, 3754. Here on now 10. Please make sure you use your calculator to confirm these figures. 10 minus 225, 862, give you 862. 2000, I think this one will give you 750. 2000 minus 1250, 750. Here we give you 3000 minus 15 minus 344. Here we give you 1156. Hope we are there. Hope we are there. Hope we are there. Yes, now we've gotten our tax written down value. Now let's add up this. This will give you 25. Hope you're seeing it. 425 plus 225 plus 250 plus 344. Now give you 1244. Add it up. Plus 25, 3744. 3744. So this is your tax written down value. So we've solved the question. Now, considering balance charge, balancing allowance, balancing charge. Now, this is your tax written down value. If you should sell this your building above this amount here as at 2021 year of assessment, above, they are going to charge, it's going to be balancing charge. But if you sell it below this amount, it's going to be what? Balancing allowance. So that is it. Now let me show you one more thing. For you to know how long this building will last, you say what? 100 divided by 10. The building will last for 10 years. Are you getting me? The building will last for 10 years. 100 divided by 10 will give you 10. So that's to tell you how long the building will last. Then the furniture, 100 divided by 20, 5 years. It's going to last for 5 years. This one, 100 divided by 25, 4 years. Motor vehicle, 4 years. I hope this video touch almost every area they are going to ask you in the exam. So you just apply this knowledge here, you can solve any capital allowance question that is what on commencement, that they are starting business with, or even the one that they are already in business, existing business. Yes, existing business, you can also solve that one. But the only except maybe cessation, when a company is that is carried backward allowance, stuff like that. So it depends. If you want me to do that, then I can roll over that one for you. But let me hear from the comment section what actually you want me to do next, apart from this one. This one have been handled, and I hope this tutorial, this very one, has impacted a lot to you. So let's keep the flag going up, and God will help all of us in this profession. Thank you very much for staying around. God bless you. Any question, you put it in the comment section. Okay, see, there's any question, you put it on the comment section. Yes. And in case here they did not use name, but in case if they use name, make sure you put the name at the head. Those ones attract marks also. So God bless you. God bless you. Thank you very much.